Hi, guys. Thanks for tuning in to another episode of Nuggets News, or our monthly housing and economy update with our friend Martin North. How are you, Martin?
Yeah, pretty good. How you going?
I'm pretty good. Now we've got these technical difficulties all sorted, and it's funny that they happen this month and not next month because you're heading off to Europe for a few months. So I'm sure we'll encounter some of those as well when we're trying to do it from different parts of the world. But excited for your overseas holiday?
Yeah, I am. I needed a change, and again, going back to Europe and spending some time with my friends and family back over there. I haven't seen them for many years because, of course, I was looking after Jill for a long period of time, and then we had COVID, and so yeah, I'm looking forward to a change of scene and probably a change of temperature too, which I'm perhaps not looking forward to. They got snow in, in the UK at the moment.
Yeah, no, you certainly deserve a break, Martin. So I hope you have a good time away. But there's a lot happening in the world of
Mm,
finance at the moment. You've prepared some slides for us, like always. Any
yep.
thoughts in general? And I should just mention we're going to try and do this a few days into the month, each month, because it is better timing for most of that economic data and the RBA decision and that kind of thing.
Yeah. Well, I mean, the general conversation, I think, is that anybody who thinks that inflation is beat and interest rates are going to drop quickly are probably sadly mistaken. So if you look at what Phil Lowe said yesterday, if you look at what the Fed said overnight, Jerome Powell was in front of the committee, the banking committee, Senate committee in the US. This conversation about interest rates needing to go higher, inflation not being beat, and all of those things. This is going to grind on for a long, long time, unfortunately, unless there's a massive crash and then they have to sort of cut to video. So, yeah, it's a really uncomfortable time for many people. And unfortunately, central banks, with their myopic view on interest rate levers and monetary policy, are, I think, taking a lot of people into very painful territory.
Yeah, and I think the question becomes, well, how are they going to try and patch these holes one at a time with more handouts and tax cuts, or we're going to
Oh,
slash this, or
fingers in the dikes, but the trouble is more and more holes now appearing in the economy, and yeah, so it really does become an interesting question. It actually takes you to what are the bounds of monetary policy, what are the bounds of central banks' ability to be able to actually patch this thing up, or is it actually going to, really slide into something rather difficult? And of course, there are lots of externals as well in terms of some of the conflicts and some of the issues. So we are in very uncertain times. I think I may have said last month, I'd never known a time when there were so many cross currents and variables all pulling in different directions. It's very hard to read. And anybody who can predict or claim they can predict what's going to happen over the next year or two, don't believe them because nobody knows.
okay, let's dive into these slides. So February, we've had a little bit of a fallback.
Yeah, so we had a very strong January. This is the Nasdaq. Everyone was saying, "Oh, New Year, everything's going fine. The Fed's going to actually pivot soon," and so everybody piled in. February was a reversal, and now we're into March, and we've had a few up down, a few down days, but overnight down because the Fed's now come and said, no, 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 we're going to have to put rates up. Now, the market is thinking in the US, the next federal meeting, which will be in the middle of March, could be a 50 basis point hike up from 25 basis point. There are more interest rates rises ahead. And that means that I think that the financial markets, particularly the stock markets, are way overvalued relative to fundamentals. And we are going to see some further corrections. And, as always, I tend to watch the NASDAQ. I tend to think that that's sort of a good leading indicator. I think we're going to see more falls there and probably other markets too.
Yeah, and a lot of other risk assets like crypto pretty much mirrored this as well. We've had just choppy downward action over the past few weeks after a pretty strong rip at the start of the year.
Yeah, and January is also tends to be a bit of an up month because you have tax receipts that then people can reinvest and a few other things. But the fundamentals are now biting. And if you go on to the next slide, the key thing to understand is that inflation isn't beat yet. And in fact, again, Powell overnight was underscoring the fact that there's still more work to do, more rate rises, the probability of 50 basis point rate hike higher. Inflation is still being driven, and it's being driven not so much by goods now, but by services. And that, of course, relates to things like the housing sector and rents. Rents are still very high in the US as they are here in Australia. And also that the income growth is moving up a little. So people are actually receiving slightly higher pay rises, but still, of course, going backwards in real terms because the inflation is a lot higher than the pay rises. So pretty much wherever you look, households are under pressure, businesses are under pressure. True over there, true here, and of course, yesterday Phil Lowe with 25 basis point hike was signalling more hikes ahead, but was a little bit more wobbly in terms of when, and they're going to be watching the data. But anybody who thinks that we've done it here in Australia and there are no further rate rises are probably mistaken. I think we're going to see more. Most economists are still talking about that. Interesting that Canada declared victory last month. That might be a bit premature on what we're seeing globally now with inflation raging quite strongly. And even in places like Japan, inflation is a lot stronger than it traditionally has been. So this inflationary genie is out the bottle, and it's hurting a lot of households, a lot of businesses. And of course, it's also putting upward pressure on the cost of government debt. And we have huge government debt around the world, and that's another factor that is going to put downward pressure on the government's ability to do other things too.
Yeah, when you mentioned there that Phil Lowe sort of talked about the possibility of pausing and being data dependent, and you and I have often spoken about how the jawboning is they're just going to say, "Oh, we're committed to getting inflation under control and continuing to hike." I think Phil's been under so much political pressure and media pressure, and that it's like we had a little bit more of a taste of honesty, even though the Fed came out and said the same thing we've been expecting, but then for once, instead of mirroring that, we got something slightly different from Phil. Did you feel that's maybe the vibe, or what man?
There might be a slight move there, but I still think that Lowe is not being totally transparent with the Australian people. I go to New Zealand, so Adrian Orr there has said on several occasions, we are designing in a recession. We need a recession to get the inflation under control. He's been much more explicit and transparent about what's really going on than the Lowe has in Australia. So, there's a little bit of nickeling and diming around the wording, but fundamentally, he's still saying we have to do more. Inflation isn't under control. It might be anchored at 2% in the medium to long term, but they're not predicting we're going to be back down into that band until 2025. So there's no headroom at the moment for any interest rate cuts on the horizon, and therefore I get frustrated when the housing bulls are now saying, rates are going to get cut quickly and time to buy into the property sector. It's too early for that. And, you're right, there's a lot of jawboning going on. But if you look at the underlying data, we had very high inflation here in Australia over the last quarter. The monthly inflation was down just slightly, but, the monthly data is a bit wobbly anyway. And we still have significant pressures in the pipeline, specifically from rentals here. So we know the cost of rents are going up. We know that the cost of goods are going up. But more importantly, the cost of services are going up. And the other thing we have in Australia, as in the US, is not just a wage price spiral, which may be only taking off slowly, but we actually have a company profit spiral, which is driving inflation. And a lot of the inflationary pressure now is coming from companies putting up the costs of goods and services through the supply chain, which means that effectively inflation is now way more embedded than people were thinking earlier on.
Yeah, we've definitely seen that inflation being exploited by those companies, with a lot of the products being pushed up just to push up profits because they can fall back on, it's just inflation. Yeah.
Well, there was a very important report out over the last month from I think it was the Australian Institute saying, the fact is that a lot of the inflation is being driven not by wages, but being driven by company behaviour.
Yes, important point. All right, so US consumers are still spending?
Yeah, so this is the other point. Of course, what you're trying to do if you're a central bank is to stop people spending and pull back a little bit. It's not working. So there's still an uptick in terms of US personal consumption, and a lot of that's being powered by debt. So we're seeing a significant rise in consumer credit in the US. And so what we're finding at the moment is as the savings ratio drops, what's happening is that people are actually still spending, but they're spending on credit, which of course is not necessarily good because it's not what the Fed wants to see. And even here in Australia, the most recent data on retail was a bit stronger than previously. December was pretty weak, January a bit stronger. They are looking for these leading indicators of consumers hunkering down. Now, I'm going to argue that we are now starting to see that happen, and we'll touch on that a bit later.
Yeah. Some more comments on stocks here, Martin? Relative valuations.
Yeah, so there was an interesting chart that came out from actually Yardini talking about something called the PEG ratio, which is effectively a forward-looking view as to where stocks are in terms of future valuations versus the future income. And basically what they're saying is that we've actually got very extended valuations, way higher than they should be. So we're actually back to where we were, you know, almost never, right? So valuations on stocks are not factoring in the fact that future earnings from most stocks are going to actually be compressed. And in fact, all the data we're seeing is that forward earnings are now coming off from those highs. And whilst they can put in prices up a little bit, they can't keep doing it. So earnings are overstated. That means that means that stock prices are overinflated, and there's a further correction due, and that correction could be quite significant. I think that's true not just in the US, but in other markets too.
Before we get to that sentiment slide, I'll just add, I think we can still possibly go into this world where there's been so much money created in the past 2-3 years. I think I read the other day there's still $5 trillion on the sidelines in US capital markets, that
Yes.
we can go to this upside down world where valuations make no sense, companies are earning less. The real economy, I think, is the thing that we can all agree is going to get hurt, and people are going to lose their jobs and whatnot. But I think we can still live in this world where stocks could start to take off even though earnings are bad and they're laying off staff and all this type of thing, simply because all this money on the sidelines is looking for a new home once they think that the worst of inflation is behind us. Even though inflation might persist, they might say, well, it's not going to be this high. We're past the peak. Let's deploy all this capital on the sidelines and kind of re-froth up this bubble right when we're actually in a real economic recession.
Yeah, I think a lot of that money will go into bonds rather than stocks at the moment, because the bond rates, of course, are very different from where they were. And not all stocks are behaving the same way. So there are still some that are actually generating significant revenue and will into the future. There are others that are actually looking much, much worse. So again, it's a massive uncertainty. But there's also a pool of liquidity, but there's also a massive pool of debt. And the question is, what's going to happen? How's that debt going to actually behave with the higher interest rates? Government debt is costing a lot more. Private debt for both consumers and for businesses is costing a lot more. So how is that going to play out? Like I said, so many variables, it's hard to really know how it's going to work.
Yeah, I agree. A lot of money's going to go into those bonds as well. I just wonder, in Australia, it's a lot less sexy to own a bond and get 5% than to tell your friends at the pub about your rental property that's getting a 5% yield. So I just wonder how these cultural things are going to come into it in the US and other markets versus in Australia. So
That's a
interesting.
good point. But of course, the gross returns on many investment properties are not 5%. They're actually closer to 2 or 3%. And in net returns now, many property investors are actually underwater. So there's been a sale of some sort of what I would call second quality investment properties in recent times, is because they can't make it work anymore. There's no capital growth. Why would I hold an investment property?
Yeah. All right, Martin. So the sentiment worsening.
Yeah, so this is just, again, from the analysts' estimates of where earnings in the future is going. And what's interesting is that the index is really dropping. It's been dropping since June last year. So the markets are saying, we don't think that profits are going to be anything like what we had previously. And that basically suggests that if you think of a share price as ultimately a multiple income of future earnings discounted, well, with interest rates higher, the discounting is higher, and with the absolute earnings lower, the bottom line is companies are less valuable, and therefore overpaying for them may not make sense at the moment.
Yeah. Now, New Zealand's still been hiking pretty aggressively.
Yeah, no, Dylan's very interesting. I use them as a case study because they're further ahead on the cycle, more transparent from a central bank perspective. Adrian Orr is much more articulate about what these risks are. And I said earlier on, engineering a recession. So rates are high, inflation is still pretty high, and more rate rises are expected. So in a way, I think you can assume that what New Zealand is doing, we'll probably see a mirror of in Australia. That's why I still think we're going to see higher rates in Australia.
Yeah, so New Zealand are at 4.2 and we got to 3.6 yesterday, so a fair way in front of us.
Absolutely right. And the markets, by the way, looking at the ASX 30 1 month ahead, is talking about 4% before, towards the end of the year. And remember that Lowe is saying inflation isn't going to be nailed until a couple of years out. So this is not a quick fix.
Yes. So we are the debt champions still. Just pipped Canada there.
Yeah, it's pretty amazing that we continue to be, from a household debt to income ratio, right at the top of the scale. We've had huge debt run-ups. We've had huge borrowing capacity. Now, the borrowing capacity is being reduced dramatically. The borrowing power is down to 35 to 40% for many households now, so they can't borrow as much. The interest rate rises mean that people are actually having to spend a lot more on their income. So a typical $500,000 mortgage compared with back before the first rate rise in May is costing now about another $1,000 a month in terms of income. So what that means basically is that people just have less money to spend, highly leveraged, but not equally leveraged, right? So there are not all households in the same boat. There's only a third of households that have a mortgage, a third renting. Well, the rents are going through the roof, so they're actually being caught. A third, of course, have effectively no mortgage, own their property outright, and probably have investments. They're doing very well at the moment because, of course, markets are still, performing reasonably well. And so we've got this real split in terms of dynamics. But the bottom line is the debt ratios that we have in Australia are way off the scale. And of course, most of that debt is actually variable rather than fixed. We have some fixed rate mortgages which will fall over into variable later in the year at much higher rates. But compared to many other countries where they have 25-year fixed loans, ours are much shorter. So the impact on households and on businesses in Australia is much more significant.
Yeah, absolutely. So new credit is rolling over quite a bit here.
Yeah, so the other interesting observation here, this is from the ABS data, that the amount of new credit is pretty much disappearing. It's also noted the only thing that's growing is refinancing. So refinancing is still quite strong. People are actually refinancing the low rate mortgages. In fact, banks are phoning people up and asking them not to move to somebody else, but actually offering them a deal to stay. But a couple of the big banks have come out and said this refinancing is not logical. We're losing money on every refinance we make at the moment, but that's what the market is doing. And that's putting pressure on the bank's margins and also meaning that the banks aren't able to pass on all the deposit increases. So effectively, depositors are losing out. The bank's margins are under pressure. And in fact, CBA said, I think, that their peak margin was last October, which is unusual because you'd expect profit margins to be rising in a high interest rate environment. When it's not, they're giving away value to compete for the only thing in town, which is refinancing. But new credit overall, significantly down.
It sounds like you're going into bat for the banks there a little bit, Martin, for not passing on those higher savings rates there for a split second.
Well, my view is there's no excuse. They should be passing on those higher savings. Roughly half of the increase has been passed on to savers. There are a few accounts with a little bit more, but you've got lots of bells and whistles and things you have to do to be able to get that. It's a very unfair situation where effectively when rates were cut, savers got lost out. When rates are rising, savers lost out. I don't defend the bank's position at all, but I do defend the rights of savers to be adequately rewarded for the risks of placing money with the banks. Remember that those are unsecured loans that you are giving the bank as a saver. You should be actually compensated for that. You're not. But the other point there is that the refinancing shenanigans going on is because the banks have actually got themselves in a situation where the only thing that's a profit engine for them is property-related lending. The only game in town is actually chasing the refinancing. So the structural destruction that we've got at the moment of the banking system is because of poor bank policy. I don't defend that for one moment.
Thanks for clarifying, Martin. I didn't think you were. All right, so new construction lending down?
Yeah, the other interesting observation is that the number of new starts, the number of new constructions is way off as well. So, the loans are falling out. That's going to have a supply issue later. So whilst there is still some completions of new properties at the moment, about 200,000 coming through, what we're going to see is much lower completions ahead. That's going to put more pressure on the supply side of property. And I've always argued that we've got plenty of spare capacity because there's 1 million properties plus that are vacant, many of which have been held vacant deliberately by property investors who never actually allow people to actually move into them. There should be a change in the law which basically forces people to actually make property available, I think, to particularly the rental sector. But the other point is that we are not getting any momentum now in terms of new business. That's putting a lot of pressure on a lot of construction firms. Many firms are going bust at the moment. Many firms are unable to actually complete work in train. And so this is another sign of a pressure point. And interestingly, this chart was put out by the HIA before the RBA announcement yesterday, and basically said that the truth is that we don't need more interest rate rises because they want to protect the property sector. I would argue that there's a real issue here as well. But structurally, we've had a 20, 30-year problem, and we're going to see this, I think, play out in the years ahead with lack of supply of the right types of property. And of course, no real affordable housing around, many people unable to get any accommodation, even for rent, in some areas. So we have a housing crisis now that's been engineered because of the financial crisis that's preceded it.
Yeah, absolutely. Something we've discussed in detail in a lot of episodes. So, plus first-time buyers are quitting as well.
Yeah, so first-time buyers way off. They're out of the market now. Their ability to borrow has dropped dramatically. Their ability to get into the market is pretty non-existent. So we're down now at levels below or close to where we were over the last decade. So this is a real bad news story. There are still first-time buyers who want to get into the market, and they are actually now being able to save their deposits a bit more because they're getting higher rates, somewhat higher rates, but their borrowing capacity has been reduced dramatically. Their ability to service the mortgage with the 3% buffer is now making it impossible, and that means that lenders are now very, very coy. And of course, the other factor is that people are saying, well, hang on a moment, property prices are going to continue to slide. Maybe I shouldn't buy now. Maybe I should wait for later. And whilst some people have been arguing there's been a little bit of an uptick in price, particularly in action in Sydney, the truth is we're going to see further falls because, of course, as I keep saying, availability of credit is fundamentally linked to what's going to happen to house prices. So I think more falls ahead. And by the way, the APRA comment recently that they're going to maintain the 3% buffer suggests they're not going to change the serviceability criteria to make it easier to borrow, with the underwriting standards staying the same. So a lot of first-time buyers really caught here.
Yeah. Next up, retail still holding up for now.
Yeah, as I mentioned, January was stronger than December, and that was a bit of a surprise. So there's still an indicator suggesting that people are actually borrowing now to spend. The savings buffers are dropping quite considerably, and essentially what that means is that we will, I think, see retail come off now. I'm expecting to see a slowdown, and of course, that in a way is what the RBA wants to see, because unofficially they need a recession or close to a recession to be able to get inflation under control. But it's unequally distributed, right? Not all households are being impacted the same way. There are some doing fine, there are some doing not fine. And unfortunately, with this blunt tool of monetary policy, sectors of the economy and individual households are being crushed. They're not able to spend. And in fact, if you look at discretionary spending, it's dropping quickly relative to non-discretionary spending.
All right, so Roy Morgan confidence heading down again, Martin.
Yeah, so it continues to show, and in fact, this was from last week. The latest data shows another slight fall. Confidence is way down. That's a very important leading indicator. It means that people are going to be more cautious about what they're going to do and where they're heading. So this is a big deal, and we're seeing confidence low here, but also in the US and other places as well. And these levels of confidence are just so low, it means people are going to put off big transactions, and maybe they're not going to try and move or buy property or whatever. And that means we're going to have a slowing economic environment. The RBA needs economic activity to stop the GDP number going south. And that's the dilemma, right? As they list interest rates, is going to hit the GDP. And the other factor, of course, here, China's come out and said 5% GDP target now ahead, which is lower than previously. That means that our exports to China might be less valuable to China. And that means that maybe the economic issues internationally will also start hitting us too. So this is a big, big challenge for many.
Okay, so some NAB Consumer Insights.
Yeah, so it's interesting that other people now are talking about mortgage stress and all of those things. NAB said 4 out of 10 Australians are in some sort of financial hardship in the fourth quarter. That's the highest in nearly 3 years. Roy Morgan's stress numbers are also up as well. So wherever you look, you're starting to see these pools of pain now. And, some people are now in financial hardship. Some said that they don't have enough money even for an emergency, or unable to pay bills like medical bills and those sorts of things. We are definitely seeing it. It's also interesting that it's very prevalent in rural areas and regional cities than in capital cities. And I'm really worried about the differential here, because a lot of the policy makers are sort of connected with the urban centres, major cities, and they would argue things aren't too bad there. But if you go out into regional, rural areas, that's where a lot of the pain absolutely is. So this is an important report from NAB and is consistent with what we're seeing in our surveys.
Yeah, and I know Robbie Barwick and the guys are still doing a lot of work with all the regional bank closures and that kind of thing. Have you been keeping on top of that as well, Martin?
Absolutely. So there was an inquiry in Sale last week when a couple of the banks were giving evidence, arguing that, well, it's their commercial decision and they don't really care for what's going on. They don't really worry about it. And they were hauled over the coals by the senators for saying, well, you didn't even come and talk to the people. You don't understand what the implications are and the fact that these regional centres are losing their last branch. And that basically is an economic disaster for these areas. There are more inquiry dates going to come through. I made another submission, and in fact, my original submission with Dale Webster is number one on the list, and then we both put supplementary submissions in, so we're right up there, and there are more submissions coming at the moment. But the banks really have no excuse other than for profit maximisation, despite that many regional centres and rural centres are losing the last branch. And we now see examples where people have to drive 400 kilometres round trip just to pay money into a branch. It is ridiculous and it's not appropriate. The banks have some sort of social obligation, in my view, because they're supported by the government. And of course, the Term Funding Facility is a good example of that. But nevertheless, the banks are just looking after their own profits and looking after their shareholders, not after the broader community. And that's a real problem.
Absolutely. GDP slowing, which we touched on.
Yeah, so GDP, just to say, was lower, and we're going to see that, I think, ahead. What was interesting there, that there were a couple of bright spots. The education sector helped a little bit with more international students coming, and our exports were quite strong, particularly because of some of the exchange rate movements. But the net underlying is looking pretty sick, and I think we're going to see more GDP weakness. Whether we'll get recession in absolute terms or GDP per capita recession, not sure, but it is definitely a big issue.
Savings buffers?
Yeah, this is another one. I mentioned the savings ratio dropping. We are seeing the accumulation of household savings beginning to drop away again. But the point is, it's not equally spread. A lot of people who actually have savings buffers actually have no mortgage. So a lot of people who have mortgage or are paying rent have no savings at all. Go right back to the NAB hardship thing. So the distributions of savings is not actually helping necessarily, but it does mean that there are a proportion of people who are actually quite happy to be able to go and buy that new car or what have you. We're also seeing, though, a rise in the sale of second-hand cars as well. So there's a lot of moving parts here and not equally represented by all types of households. Savings buffers, though, depleted and back to pre-GFC levels.
And depositors, we spoke about this as well, the retail online deposit rate versus the cash rate.
Yeah, so, like I said, we haven't seen the full passing through of those deposit rates because the banks are actually subsidising the mortgage side of the book, particularly refinancing. But many people are still sitting on low rates, very low rates. They haven't shopped around. So I keep saying to people, shop around, you can get a better rate. If it's not got a 3 or a 4 in front of it, you're on the wrong deposit account.
100%. Profit price spiral, which you did touch on before as well. And this is the big worry about wages starting to increase and fueling inflation further.
So this was a really important report that came out, and whether you believe their modelling or not, and a lot of people sort of tried to pull it apart, what they were arguing was that actually if you look at the cause of inflation, most of it is actually not created by wage rises, when of course the RBA is saying we can't allow wage rises to go above 4% because that will be inflationary, but actually it's to do with company profits and Company profits have risen very significantly and relative to income growth, way higher. So effectively what we have is corporate sector doing very well and shareholders therefore benefiting. And that's actually driving inflation much more strongly. And their argument is if you really want to control inflation, you've got to tackle this profit price spiral. That's where a lot of the inflation actually is. And I think there's some merit in that. And of course, some people came out and said, well, that means that actually you shouldn't be trying to stop wages growth. You've got to allow that to happen. The other point is that we've got a corporatization of Australia and the Australian economy. There's too much focus, I think, on corporate profits and shareholder returns and not enough on the broader economy and on the households.
Yeah, I completely agree with that. It's an interesting report, counter to what we get told a lot of the time.
Yeah.
The definition of stress?
Yeah, well, just I've shown this slide before, but just there's lots of different ways of looking at stress. I look at it in cash flow terms, money in, money out. Others use different terminologies, methodologies. Roy Morgan, for example, uses a one that is closer to the bank underwriting. But the point is, my modelling is saying if you've got more outgoings than incomings, then basically you have a problem. And we've got a significant rise now. Also investors, of course, too. And we look at it both in counts and also numbers of households. So it is a big deal. But the Roy Morgan numbers that came out were quite significant because they are now saying, based on where they think rates are going by April, 1.45 million households, or 29.5% on their definition of stress, would be actually significantly exposed. And that's the highest it's been for a long, 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 long time. So everyone, whether it's the NAB, whether it's Roy Morgan or my data, is saying the same thing. We have a real structural issue now with regard to the pressure on households. And my own stress data, which came out to end of February, showed that we've got 46.7% of households, which is the highest it's ever been in terms of mortgage stress. And we've got rental stress. So more than 61.8% of households in the rental sector are in cash flow pressure on the rents. And of course, we've got this high debt to income ratio. So we really, really have significant pressures now. It's really biting, high numbers, more people in more difficult situations. More people are working more jobs. So that was a report that came out quite recently that said we've got now people working extra hours, doing extra gigs to try and cover the additional costs. And somebody did a calculation that said if you wanted to cover the additional costs of mortgages compared with last year, you need to work on an average income of an extra 29 hours a week just to cover the costs. It's pretty horrendous.
Any major changes to your projections?
So in terms of the scenarios, what I'm thinking is that we will see, best case scenario, property prices sort of over the next 3 years come back to roughly where they are. But if we see recession, if we see higher interest rates, my central scenario is we still got another 10 or 15% to go on property prices. And if we actually have a recession here, then it could be worse. So, these scenarios are just sensitivities in terms of what may happen. But it does come back fundamentally to where interest rates are going to go, how high the RBA will take rates. And I'm seeing no evidence yet to suggest the RBA is likely to pivot anytime soon. And that means that we're going to have higher interest rates for longer. The 2025 time horizon is when I think we might well see things begin to ease back. But I cannot see a way where house prices are going to rise over the next year to 18 months. It's going to go sideways or down. And that means that people need to actually tailor their decisions based, of course, on their own personal circumstances and their ability to service mortgages. But don't bank on any capital appreciation from the property sector for the next couple of years.
Well, Martin, I appreciate you powering through all that stuff with us today. Next time we see you, you will be in Europe, hopefully with the Eiffel Tower or Stonehenge or something in the background for us, maybe. But no, thanks for joining us. And any words for everyone before you head off over to Europe? Or I'm sure you'll say probably goodbye on your channel.
Yeah, I mean, I've been sort of winding down a little bit. I will be continuing to make some shows on my channel. I will be continuing to run, a few other conversations with other people too. I've got some technology which will be portable, so I'll be able to do that. And I'll look forward to continuing to talk about and update the Australian property sector and financial sector. I'll still run the Australian surveys. I'm still doing servicing work for a number of clients in Australia. So whilst I'm locating to a different location, I'm not going to disappear. And I'll continue to hold the Australian government, the RBA, and everybody else to account for how the economy is behaving here.
As long as you take some time for yourself, Martin, I'm happy with that. So thanks again, guys. We'll see you next month. Cheers, Martin.
Cheers.